Morning, it's Wayne Morgan. It's Wednesday. I'm Wayne. This is Wednesdays with Wayne. So thank you for showing up. Before we get started today, I have a really great topic. I'm glad you showed up. I'm really anxious to get into it. Before we do that, I want to thank our sponsors. First of all, Mark and Facebook. Thank you for sponsoring this event. I mean, really, it's kind of cool. Don't you think that they'll do this for free? So thank you for doing that. The editors, the people that work on it, the person that's going to edit this video. Thank you for doing that. Thank you for sponsoring this and let us to give our message out. The First Amendment is still alive and well, so thank you. The second group I want to thank is the Real Estate Business School, where you get your license and learn to use it. This is the learn to use it part. A license is a tool. Unless you know how to use it, it's like any other tool, it's useless. So we teach people how to use it. The other first people I want to thank is you. So I want to thank you for your time. And I do that because a long time ago, and those of you probably heard me say this so many times, you're sick of hearing it. But truly, I want to thank you for your time. And I do that because a long time ago, a friend of mine said to me, the most valuable thing anyone can give you is their time. So thank you for your time. We'll do our best to make sure today that your time is well spent. Thank you for showing up. The two most valuable, three really valuable assets you have are time, energy, and money. And as business people, we need to be good stewards of those resources. So where we spend our time matters. Where and how we spend our money matters. And where we spend our energy matters. We've got to get a return off all three of those. So we'll do our best to make sure that when this session's over, you'll say, well, that was worth my time. So thank you. I'm glad you're here. I've been observing, watching, listening to what people are saying during this COVID event that we're in. So I decided that I want to talk about something that might be relevant to everybody. These are just my observations. I'm not an accountant. I don't have a degree in finance. Most of what I'm going to talk about today is just based on what I've read, my personal experiences, and my observations. So if you go look for the book, you won't find it because I haven't written it yet. So this subject it creates a lot of anxiety, frustration, confusion, fear, divorce. No, not the virus, money. So today I want to talk about the difference between money and wealth and how you can convert money into wealth and what I see as the issues and what I see are the opportunities. So thank you for your time. I want to start with this. This is consumer debt in America today. Almost 14 trillion, 13.86 trillion. This is the amount. Consumer debt in America. Even in Texas, that's a big number. So there's a lot of debt, which is fine as long as you had a good job and you keep it, you get your bonuses and your raises. Debt's not an issue. The problem is that's bad debt. So that's a mess. Well, I'm going to go into this because there's a lot of fear and anxiety. I've been hearing it a lot from a lot of different people. So today is about the difference between money and wealth. There's a crisis in America. There's a financial crisis, and I think it's about to explode or implode, depending on your point of view. But it's more than a financial crisis. It's the crisis of education. And so we give our teachers, and I don't know what kind of teachers you had. I had pretty good teachers, and they meant well, and they taught well, but they were not given the financial curriculum to teach us. So I did not receive the financial education that I hoped I would have gotten in school. But I don't want to blame the teachers. There's plenty of blame to go around. I don't really want to blame anybody because I don't want it to go into that. It's not about blaming. It's about finding a solution and fixing it. And I think we need to become more active in teaching our children about finance, about money, and learning more about this subject ourselves. And the reason I say it is because I went broke in 1985. I was down a couple million until I moved to Austin to start my life over. So I started studying this subject. It was very clear I knew very little about it. So I've been educating myself on this subject ever since. I'm not saying I know it all. I'm just going to share with you some observations, okay? So the first thing is that we're taught, speaking of education, our education system is designed to create a product called employees. What are we taught when we go in there? Excuse me, from a very young age. From a very young age. What are you going to be when you grow up? So it's be good, do as you're told, make good grades, get a good job, work hard for money. The problem is money loses its value over time. And the majority of the population, there's the number I heard was 3% of the world population control over 80% of the wealth. And the reason why is because of the education, what they know and what they do with their money. So the problem with money is it loses value over time. And majority of people don't invest their money. They buy things that lose value over time. So when you work your whole life for something that loses value over time, which is money, and you use it to buy things that lose value over time, it's no wonder there's a financial crisis. So I want to go into this a little bit. The first thing I want to talk about is opportunity cost. You are looking at an opportunity cost right now. So an opportunity cost is when you have investment A and investment B. You choose investment A, it's mediocre, it breaks even, or it's a dead dog loser, and B takes off and is a home run. The difference you could have made with B versus what you made with A or lost with A is your opportunity cost. That's the money you could have made over here that you didn't make or lost over here. Excuse me, opportunity cost. Right now, this time that you're giving me is an opportunity cost. What else could you be doing with your time right now that would increase your life in whatever way? Mentally, physically, emotionally, physically, financially, spiritually. So everything has a cost to it, especially time, especially money. That's why I want to thank you for spending your time and money with us. So to me, it's better to invest with A and lose than to not invest at all and not know anything about the subject. I've told people before, they said, "Oh, you lost a couple million." I said, "Yeah." I said, "Well, you must not know very much." I said, "I didn't before, but I do now." I don't recommend it, but it was very educational. Woo. Based on what I learned from that, I've gotten through 2 recessions and a pandemic. So again, I'm not suggesting it. There are more easier, better ways. That's what I'm suggesting. But it was educational. And all I'm suggesting, ladies and gentlemen, is that we learn from our mistakes. And if you invest and lose, at least you learn what not to do. You may not know what to do yet, but you know what not to do. So there's a value to that. Making mistakes and correcting them is valuable versus punishing people for making mistakes. So to me, it's just a point of view. I was talking to somebody in this group. There's another point. So the first point I want to make is opportunity cost. You're better off losing money than doing nothing. At least you learn. The other one is this phrase that struck me as being odd. When people have more money than they need, so you get paid every month, this income comes in, you have money left over, what's that called? Disposable income, right? Why do we call it disposable income? When I think about disposable, I think of something you need to get rid of. I mean, my garbage goes down in a garbage disposal. It's disposable food. Get rid of it. And when you buy property, you get rid of it. You dispose it. It's a disposition. It's the sale. You dispose. You get rid of it. But why is it called disposable income? Well, disposable income. It's not disposable. Why don't we just stop calling it disposable income and start calling it investable income? So, okay, here's how much we need. Here's how much came in. We've got some extra. Let's not dispose of it. Let's invest it. Let's set it aside. Let's go find something. Let's invest in it. So if you can buy into the fact that money, that we got to quit working for money and we should start investing it. So money by definition is an idea. It's just an idea. I mean, we haven't been on the gold standard in decades. There's nothing to support our economy except our confidence in it. And that's what drives the stock market up. Confidence and greed drives it up, and fear and uncertainty drives it down. Everybody knows that. So the definition of money is an idea backed by confidence, representing work, and it's exchangeable. So if we had no confidence in the system, it would collapse. And that's what the stock market's been doing. That's why I'm going to give you 2 choices to make. I'm going to go into why real estate is better than mutual funds all day long. But if you look at the greed and the certainty, that drove it up, and the fear and uncertainty and doubt that drives it down. Real estate hasn't done that. The market's gone through some major stock markets, some major fluctuations. So money is an idea backed by confidence. If you didn't have confidence in it, you wouldn't work for it. You would not accept it in exchange for your labor, right? Right. It represents work truly done. So we're taught to exchange labor for money, which you got to stop doing. You got to quit working for money and get money to work for you. When you pull a dollar bill out of your pocket, just ask your question. Do I work for it? Does it work for me? Is money my employee or my employer? And if you're working for it, it's your employer. You're the slave, for sure. And if it works for you, now you're on the right track. Okay? It's representing work truly done and is exchangeable. If you couldn't exchange it, you probably wouldn't accept it. So that's money. And what I'm talking about is this difference. I was told when I was young, those people over there have lots of money. They're very wealthy. Well, okay, that's fine. But later on, I learned that there's a huge difference between money and wealth. So here's wealth. You've probably seen me do this before, but I want to do it again because I think it's worth repeating. This is wealth, ability to survive blank number of days into the future. Please write this down. The ability to survive blank number of days. So there are different forms of wealth. Your physical health is a form of wealth. Your mental health is a form of wealth. Your spiritual and emotional health is a form of wealth. I get there are all these different forms of wealth. I get it. I get it. I get it. I agree. No argument. I'm just talking about the financial aspect of wealth today, okay? So my question to you is, if you stop working today or were forced to stop working, you didn't sell your assets. Look, everybody's buying stuff, the price goes up. Everybody starts selling it all, the price all goes down. So when you start trying to sell these non-assets into a market whereabouts is selling to, your price is going to fall even further. So 3 criteria. Stop working today. Do not lower your standard of living. You can't move out of your mansion into your condo or out of your condo under the bridge. And you cannot convert anything to cash. So if you stop working for money today, didn't lower your standard of living, and didn't convert anything to cash, how many days into the future could you survive financially? And that's your wealth. So write the number in the blank. If you don't know your number, you're in trouble. If you don't like your number, you're in trouble. So the goal is to stop spending money on things that lose value and start acquiring assets with them. And this is an interesting point of view I see from people. I mean, they say they won't invest into a piece of property that someone else will pay for them. But they'll go out and they'll spend 30, 40, 50, 60,000 or more on a vehicle, an SUV. I mean, they'll spend money in these SUVs that cost 50, 60, 70,000. These pickup trucks, you kidding me? 50, 60, 70,000 bucks for a pickup truck or an SUV, and you're spending now, what, 800, 900 a month? Well, what if you could have bought a piece of real estate that didn't cash flow? And let's say you had to feed it to the tune of 800 a month. Eventually, that SUV or pickup is going to lose value and deteriorate to zero. But that real estate, if it were purchased, even if it cost you that money every month, ultimately goes up in value. Everybody knows that. So this point of view that I'm not going to invest because it's risky, I'm not going to spend money feeding that asset, but you happily buy an SUV. So this is the type of education people have. This is the reason they struggle financially. So all I'm saying is, would you buy real estate, even if it had negative cash flow? Or would you prefer to look good, be cool, and go nowhere? So this is the definition of economic recovery. When people spend money they don't have to buy things they don't need to impress people they don't know. And if you listen to the news, that's exactly what they call it. They say consumer spending is up. The economy has recovered. So when you take on this kind of debt, the government calls it an economic recovery. That's the problem, from my perspective. So I'm suggesting, ladies and gentlemen, we make more than we need. We don't call it disposable. We call it investable, and then we invest. Okay? So, past 8 weeks, stock market, holy moly. Has it taken a ride or what? And so if you watch, it fluctuates. Of course it fluctuates. A lot of this because businesses are losing value. And it's all about shares of stock in those companies. And some are gone and not coming back. Some are on the brink and may or may not survive. It's a very difficult time, I agree. This aberrated economy, it's very strange. What I'm talking about is the principles of finance, the principles of wealth, if applied, will get you through the economy no matter what the economy does. So the stock market has lost a lot of its value in the past 8 weeks. Your real estate values have remained fairly stable. The piece of property, the properties that you own are pretty much the same, worth the same as they were 8 weeks ago, 12 weeks ago. The stocks probably aren't. Now, I admit there may be a lag there. We've got some people that are out of work that may not be making their mortgage payments. We've got some companies that are definitely not making their lease payments. So when those commercial properties, which is valued by the income stream, they start losing those income streams, those properties are going to be worth less. It's going to be several months before we know what those valuations are going to end up being, but it's never going to zero. They'll never go to zero. So if you look at, this is what I saw on CNBC as of last Friday. Actually, it wasn't last Friday, it was the 15th. 36.5 million people are jobless. That's a bunch. 560 commercial Chapter 11 bankruptcies. So we're in the middle of this pandemic. There's a lot of anxiety, a lot of fear. There's also a lot of confidence and a lot of hope, because no matter which way the economy goes, it's always a good time to make money if you understand the principles. So who's making money in this environment? A lot of companies. So real estate will be affected. We don't know when or by how much. But all I'm saying is, to me, real estate is a lot better than mutual funds. So I'm going to go into reasons why real estate is better than mutual funds. And for me, there are 12 reasons why. And here they are. First of all, if you buy a mutual fund, what are you buying? You're buying a pool of assets with a bunch of other people to diversify your risk. Well, as Warren Buffett said, diversification makes no sense if you know what you're doing. I'm no Warren Buffett, but I like his quotes. What's he been doing lately? He's selling, right? So with a mutual fund, do you have to use your own money? Yes. With real estate, what do? Use someone else's money, right? Right. 2, go call your banker today. As soon as the session's over, call your banker and say, hey, look, I got a hot tip on a great stock. How much can I borrow? And see what they say. So if the bank won't loan you money on a mutual fund, what does that tell you? But will your lender, will that same lender loan you money on a piece of real estate? Absolutely. When you buy a mutual fund, you're giving your money to someone else to control for you. When you buy real estate, you're getting money from someone else that you control. Your mutual funds typically do not cash flow. Your real estate, if bought properly, will cash flow. It sends you passive income every month. When you buy a mutual fund, there's 2/3 of a chance of loss. That thing's either going to go down or break even, which is the loser. So 2/3 of a chance of losing. In real estate, you make your profit up front. Those you out there who are investing in real estate, you know the answer to this. I'm going to ask it anyway. When is your profit made in real estate? Right, when you buy. 6, mutual funds, do you pay tax on the gain? Yes. You put capital to work, it generates income, you show a profit, they dispose of some of your securities or whatever you bought, you make a profit, you owe tax on that. With real estate, there's no capital gains tax if you exchange it, which means you just trade up. It's not a 1031 class. That's a huge subject. Not the time or the place to get into it, but you can absolutely avoid or defer your gain on real estate using a 1031 tax deferred exchange. No capital gain. Can you depreciate your stocks? If your stocks, while you hold them, if they go down in value, or even if they go up in value, can you depreciate them? Of course not. Can you depreciate your investment properties? Yeah. There's a part that's the land, there's a part the improvements. The improvements are the cabin, the house, the duplex, the commercial office building, the multifamily project. What are the improvements are is the structure you put on the property. Those have a useful life, and you can depreciate those annually over the life of that loan. So you can depreciate and take that off your taxes. It's a tax deductible event that reduces your tax consequence of commercial real estate and investment real estate on depreciation. You can also depreciate the furniture, fixtures, the contents inside, because they have a shorter life. So you even have this, there's all different kinds of depreciation. There's even accelerated depreciation. There's some things you can buy and depreciate them in the same year they're purchased. So the government wants us providing housing and jobs. That's why they give business owners and investors tax breaks. Employees and stock investors don't get. Could your value in any stock, is there ever a possibility it could go to zero? Of course. It happens. Will your real estate ever go to zero? No. Even if that building burns down or a tornado, hurricane takes it out, that land is always worth value. When you give your money, number 10, when you give your money to these investment managers, financial advisors, my question is always, okay, you want me to put my money in that fund? Yeah. A mutual fund, right? Yeah. The problem is there's nothing mutual about a mutual fund. Only person making money, the person that sold it to you. Just ask them, how much money do you have in the fund? And see what they say. So when you give your money to a financial advisor, you have to hope that management is good and that they manage your money wisely. With real estate, you're the manager, and you can increase the value of that asset. So you're making money as opposed to the industrial age where we're taught to exchange labor for money, which is a crazy idea, and it doesn't work, but people do it anyway, and when they don't have enough money, they actually do more of it. They get OT. I'm gonna give me some OT. So what they're doing doesn't work already, so they just keep on, they double down. Stop working for money. You make money with your mind. Understand, money is created, wealth is built over time. We're in the information age now. You make money with ideas. You make money with your mind. Look at the new breed of billionaires coming on the planet. They don't make money by outworking everybody. They outthink. Yeah? You're making money with your mind. You do everything, you do so much more with so much less. You do everything with almost nothing. I mean, look at this. I'm talking to hundreds of people right now from my kitchen. It's unbelievable. You can increase the value of that asset, and that's how you get paid, by using your mind. We're transferring from the physical to the metaphysical. Information age. We're transferring from brawn to brain. It's not about being the strongest, it's about being the smartest. It's about applying the principle of leverage. Next one, number 11. When you buy a mutual fund, do you pay a commission? Yes. When you buy real estate, do you get paid a commission? Yes. Pull that commission out of that property. If you're licensed, you get paid a fee for buying real estate. Then lastly, number 12, can you buy mutual funds with no cash and no credit? Probably not. Okay, no. Can you buy real estate with no cash and no credit? Yes. Look at it. You're sitting in it. I'm sitting in it. We bought this with no cash. I have credit, really good credit. No cash down. So you don't need cash or credit to buy real estate. You need the deals. There's money looking for good investment opportunities. So you don't need the cash or the credit. What you need is the financial education to find the deals, to put a loan package together to convince investors that your deal is a safe deal, it's a good deal, it's got good ROI, And that's the best deal they're looking at today, that the opportunity cost with you is the best. And that's how you raise money for deals. That's the 12 reasons why I think real estate is better than mutual funds. Any questions? Okay, I have one more document I dug up for you if you want to hear it. This is the difference between real estate buyers and real estate investors. Buyers live in the home. Investors live off of the home. The buyer asks, how much are the payments? The investors, when they're considering a buying opportunity, they ask, how much are the rents? When a buyer's looking for a house, oftentimes you hear them say, this house needs work. Keep looking. The investor will say, this house needs work. Offer less. The buyer says to their realtor, show me some homes. The investor says, show me some numbers. The buyer asks, how much are the taxes? The investor's question is, how much is the ROI? When the buyer buys for the home, they pay for the home. When the investor buys a home, the tenant pays for the home. When's the only time you ever borrow money? When someone else pays it back. Who's paying back the money that you borrowed? If it's you, the buyer buys a home to live in. Investors seldom live in homes they buy. For the buyer, the property is a liability. For the investor, the property is an asset. So, this is from Rich Dad, Poor Dad, Robert Kiyosaki. If you haven't met Robert or traveled with him or been to his seminars or workshops or read his books, I highly recommend you read Rich Dad, Poor Dad and Cash Flow Quadrant. And this is Kiyosaki 101. And he really does a great job of explaining this and make it really simple to understand. So if you read Rich Dad, Poor Dad, what he says is asset. If you have an asset that creates cash flow, what it will do is feed you if you stop working or were forced to. Well, an asset would eat you. So if you can agree with these definitions, assets feed you and liabilities eat you, then you'll understand that your house is the biggest liability you own. Because if you stop working today or were forced to, it would probably eat you fairly quickly. So to the buyer, the homeowner, their house is a liability. To the investor, it goes in the asset column. Buyers cannot deduct improvements from your taxes. If you go fix up your house, you go to Lowe's, Home Depot, a hardware store, whichever one it is, and you fix it up, you can't deduct those expenses. If that were an investment property, you could deduct those improvements from your income tax. The buyer pays for the improvements by working. The investors pay for the improvements from their property from rents. If you have an investment property, typically they'll fix it up. So for you, those of you thinking about investing, if you'll buy a commercial property, and we like single tenant office buildings, you put these tenants on a triple net lease, so they pay the taxes, the insurance, and the maintenance. So you give them a low base rent, and then the taxes go up, they pay the taxes, they pay the insurance, they pay the maintenance. They typically don't move out in the middle of the night. This is their business. They don't want to move. This is their business. They have that address. They want to keep that address. They want to be a stable, steady company, reliable, credible. They don't move. They fix up the buildings. They paint them, they fix them up, they'll do it for you. The homeowner, the buyers, they pay for their personal home from their job. The investor pays for their homes, their real estate, from rents, from cash flow. And buyers the homeowner cannot depreciate the property. Investors can depreciate their properties. Lastly, the homeowners raise children and the investor raises rents. That's the difference between mutual funds and real estate. Those are 12 reasons why I think real estate is better than a mutual fund. And those are the 14 reasons why the difference between buyers and real estate investors. So, short session today. Hope that helps. Real Estate Business School, where you get your license and learn to use it. 3 types of education: the technical education to get a license, the business education your clients expect you to have, and financial education to create your own wealth. I'll see you next Wednesday. Thank you for your time. I hope you found it valuable. Let's go out and make it a better world. Thank you very much.